Welcome to the Deep Dive. We're here to break down what you really need to know from today's Royal Philips earnings call.
That's right. We'll sift through the Q1 2025 results and commentary from CEO Roy Jacobs and CFO Shellet Henneman.
We'll give you the key takeaways, the numbers, the strategy shifts. Let's jump right in.
Okay.
So, starting high level, order intake saw some growth, which is interesting given the backdrop.
Yeah, especially because they had a pretty steep double-digit decline in China, so growth elsewhere must have picked up the slack.
Exactly. North America was strong, double-digit growth there, and diagnosis and treatment areas performed well overall.
It sounds like they ended the quarter with some positive momentum, even with all the macro uncertainty floating around.
Right. And that China weakness offset by strength elsewhere, it really highlights the importance of being diversified geographically, doesn't it?
Absolutely. You can't have all your eggs in one basket, especially not in today's global economy.
Okay, now actual sales. They did better than their previous outlook.
Yeah, that was driven mostly by personal health growth, it seems, and also some royalty payments hitting the books maybe a bit earlier than planned.
The timing aspect. Got it. And what about profitability? Margins look better.
They did. Both gross margin and the adjusted EBITDA margin improved. They put that down to new product innovations and their ongoing productivity push.
Which is a good sign, right? Improving margins even when overall sales were down a bit compared to last year.
Definitely. It shows they're focused on the quality of earnings, not just chasing volume, finding efficiencies.
Okay. And one big item was that Respironics settlement in the U.S.
Yeah, a huge one, around $1 billion paid out. That basically closes the book on the U.S. personal injury and medical monitoring claims.
Removes a big chunk of uncertainty, I imagine.
For sure. So looking ahead, their full year 2025 sales outlook, that stays the same. Comparable growth between 1% and 3%.
But the profit margin outlook changed slightly.
Just a bit. The adjusted EBITDA margin target is now 10.8% to 11.3%. That's down about 100 basis points.
And that's purely because of tariffs.
That's what they said, yeah. Even after factoring in their efforts to mitigate the impact, it shows how real those trade costs are.
Wow. Okay. And lastly, free cash flow for the year.
They're projecting it to be slightly positive, which honestly, after paying out €1 billion, still ending up cash positive is, well, it shows some underlying cash generation muscle.
Definitely. Okay, let's dig a bit deeper then, starting with those orders.
Right. So they stress that customer demand for their new stuff, their innovations, was strong. And they're getting better at, actually delivering operational execution.
And if you strip out that China decline,
comparable order intake was actually up 4%. Pretty healthy.
Where was the strength particularly?
Diagnosis and treatment orders grew mid-single digits globally. Image-guided therapy and precision diagnosis were standouts.
Image-guided therapy, that's the Azurian platform, right?
Still popular.
Very much so. And they're adding AI features now, like for neuro procedures, which is boosting demand.
And precision diagnosis.
Yeah.
CT scanners and such. Yep. Strong order growth there too, driven by their newer systems. The CT 5300 and the Spectral CT 7500 both have AI baked in, of course.
Seems like AI is everywhere in their portfolio.
It really is. Even MRI showed good momentum, helped by their helium-free systems and, again, AI engines.
What about connected care, hospital monitoring?
Solid growth there, especially in North America. They mentioned partnerships helping, and their IntelliSpace platform.
And enterprise informatics, the software side.
Order funnel looks healthy there, they said. Partnerships like the one with AWS are key. They expect strong growth in the second half of the year for that part of the business.
And overall, this growing order book, it's got better margins now too.
Yeah, that's a crucial point. The order book's steadily increasing, the margin profile is improving, and it represents something like 40% of their expected revenue. Gives them good visibility.
Okay, let's talk more about that innovation piece, especially the AI angle.
It's clearly central to their strategy. They said over half their current sales come from AI-driven products launched just in the last 3 years.
That's quite fast.
It is. And the collaboration with AWS, bringing generative AI into their Health Suite imaging platform. That sounds potentially transformative.
Automating summaries, conclusions, quality checks.
Exactly. Stuff that could really save clinicians time and improve accuracy. And they also launched that SmartSpeed Precise for MRI back in February.
Right, using dual AI engines for better images faster.
Yep. Across their whole MRI portfolio, includes those helium-free ones. It's all about embedding AI to add value.
Okay, shifting gears to execution. How they're running the business. What were the priorities there?
Patient safety and quality, number one. Then supply chain resilience and just simplification, making things less complex.
How are they simplifying?
Well, they're on track to slash the number of quality management systems by 70% this year. That's huge. And they said supply chain lead times and service levels are getting better, back in line with the industry. Plus, they're making real-time tweaks to handle tariffs.
Makes sense. Any specific areas for simplification?
Yeah, they're focusing on hospital patient monitoring and CT platforms now, after seeing good results simplifying other areas.
And this simplified operating model, it's meant to make them faster, more accountable.
That's the idea. More agile, focused on growth, and it's already delivering savings $42 million in productivity just in Q1.
Okay, let's look at the different markets. A bit of a mixed bag, wasn't it?
Very mixed. North America, fundamentally strong demand from hospitals. CapEx plans look stable there.
China.
Still watching it closely.
Right.
Some government stimulus is happening, but they haven't seen a major shift in market dynamics yet. Still weak, especially on the consumer side.
And elsewhere, Europe, other growth markets.
Hospital CapEx is solid across most of the rest of the world. Demand's actually picking up in Europe. And personal health saw really strong growth in Europe and other non-China growth markets.
So strong personal health outside China, weak inside China, hospitals strong in North America, picking up in Europe, still softish in China.
That's pretty much the picture. It really highlights why they need different strategies for different regions.
Now, those tariffs, a big topic. U.S.-China especially.
Huge. They've been working on making their supply chain more resilient for years, diversifying away from single points of failure, especially in China.
And now they're speeding that up, focusing more on the U.S.
Exactly. Accelerating efforts towards the U.S. Mitigation tactics include optimizing supply networks, manufacturing, managing inventory carefully.
We're going to get exemptions too.
Yeah, pursuing exemptions like under the Nairobi Protocol, using duty drawbacks, also selective price adjustments, and just building more operational agility.
But even with all that, there's still a big hit.
Yep. Net impact expected for 2025 is somewhere between 250 and 300 million. Mostly from the U.S.-China tariffs, because the rates are so high there.
And it's going to bite more later in the year.
Probably. Because of how inventory costs flow through, they've got teams working flat out on finding more ways to lessen the impact for this year and next.
And they're keeping costs tight elsewhere, right, while still investing in R&D.
That's the balancing act. Strong cost discipline, managing discretionary spend, but protecting innovation. And they're also talking to governments, pushing for open markets for medical gear.
Okay, let's get into the segment financials. Diagnosis and treatment first. Sales were down.
Down 4% comparable. Again, that double-digit China decline was a major factor. Plus, they were comparing against a really strong quarter last year.
But image-guided therapy held up.
It did. And interestingly, the adjusted EBITDA margin for the whole segment actually ticked up slightly by 30 basis points to 9.5%.
How'd they manage that with lower sales?
Productivity gains, a better mix of products sold, and the impact of those innovations helped offset the lower fixed cost absorption. Shows some resilience.
Okay, connected care.
Comparable sales were basically flat. Hospital patient monitoring was up, but the overall segment margin declined to 3.5%.
Why the margin drop there?
Unfavorable mix, mostly, and some cost phasing. Productivity and innovation helped cushion it a bit, but not enough to offset.
And personal health, the consumer side.
That saw growth again. Comparable sales up 1%. Really strong double-digit growth in Europe and other non-China growth markets. Slight growth in the U.S.
Offsetting the China drop.
Exactly. China was down double digits there too. But the margin held steady year over year at 15.2%. Pretty solid.
So wrapping up the group results, overall comparable sales down 2%.
Yeah, driven by those China declines across the board and the tough comparisons in D&T. But if you look outside China, sales were actually up slightly, thanks mainly to personal health.
And the group adjusted EBITDA margin.
Down 80 basis points to 8.6%. But they frame it as resilient given the headwinds, thanks to higher gross margins and those productivity savings.
Speaking of productivity, how much did they save in Q1?
$147 million. They're on track for their $800 million target for the full year 2025.
Net income looked way up, but that was mostly due to last year's legal provision, right?
Correct. Net income was $72 million, up $1.1 billion. But that's almost entirely because of the big Respironics charge they took in Q1 2024. Not really an operational improvement indicator this time.
And free cash flow. Big outflow.
Yeah, an outflow of $1.1 billion. But again, context is key. $1 billion of that was the Respironics settlement payment.
So excluding that one-off payment.
Excluding that, underlying free cash flow actually improved by $270 million compared to last year. So operationally, cash generation was better.
Okay, what's the outlook for Q2 then?
They expect a modest improvement in both sales and adjusted EBITDA compared to Q1.
Still factoring in weakness in China.
Yep, they're still expecting a double-digit sales decline there, mainly in personal health, as that inventory destocking wraps up. And the usual caveats apply. Outlook excludes wider economic shocks or ongoing Respironics stuff.
Got it. Let's touch on some Q&A highlights, more on tariffs.
Yeah, they confirm most of that 250, 300 million net hit is U.S.-China flows because the tariff levels are just so high, like 125%, 145%. Europe's impact is much smaller.
And mitigation includes inventory management, duty drawbacks.
Right. The Nairobi Protocol for drawbacks, cost control, productivity, selective pricing, all hands on deck.
Did they see any impact on ordering patterns?
A little bit. Some customers apparently ordered ahead at the end of Q1, maybe expecting prices to go up because of tariffs. But they said the sellout momentum in personal health is strong, which backs up their full-year view. And that personal health inventory destocking in China, that's done now.
And overall inventory levels?
Actually down year over year in Q1.
Yeah.
Slightly up from Q4, but that's normal seasonality.
Which segments are most hit by tariffs again?
Diagnosis and treatment and personal health. Connected care, less so because there's less U.S.-China trade in that segment.
Okay. What else came up about China specifically?
The procurement environment is shifting. More towards centralized buying, looking at a mix of price and quality, not just pure value-based like some might hope.
Interesting. Any bright spots in China orders?
Surprisingly, yes. Ultrasound orders were positive in Q1, driven by new AI features in their VM platform, especially for cardiovascular.
And the government stance?
Beijing put out a plan to stabilize foreign investment, affirm support for foreign companies, even said they'd look into unfair procurement practices. We'll see.
But the overall China outlook for Philips this year is still negative.
Yeah, mid-single to high single-digit decline for the full year, mostly front-loaded in the first half. The second half might look better growth rate-wise, but that's mainly because the comparison gets easier, not because the market's roaring back.
Got it. What about the U.S. market? Still looking solid?
Seems so. Underlying demand from hospitals is strong. Patient volumes, procedures are up. Customers want efficiency, productivity solutions.
And Philips is doubling down on U.S. manufacturing.
They are. Using existing sites, some new investments, like in Minnesota for cardiac devices. It's a direct move to mitigate tariffs faster and more cheaply by making stuff closer to the U.S. market.
Makes sense. Let's talk margin expansion. Still opportunities there?
They think so. Driven by 1, ongoing tariff mitigation efforts, 2, more productivity. They upped their 3-year target to $2.5 billion now, and 3, continued innovation helping gross margin.
And shifting the business mix.
Exactly. Grow the higher margin businesses targeting 70% of revenue from those areas by 2030 and fix the margins in areas like connected care.
And just to confirm on free cash flow for 2025.
Updated outlook is slightly positive. After that $1 billion settlement payment, the reduction from their previous guidance is entirely down to tariffs hitting cash flow up front.
Before they even hit the P&L fully.
Right. And they're still focused on working capital, pointing to that year-over-year inventory reduction.
All right, let's move to our This Is Not Financial Advice segment. Time for some outrageous but plausible trade ideas based on all this. Idea number 1.
Okay, so given Philips' heavy push into AI for medical imaging and how solid that North American demand seems despite tariffs, how about this? Go long a U.S.-focused healthcare tech ETF.
Okay, playing the U.S. strength and innovation angle.
Right, and maybe hedge out some of that China risk by shorting a China-heavy emerging markets ETF. The thinking is Philips' specific strengths in the stable U.S. market could win out over broader EM trends weighed down by China's issues and tariffs.
Interesting. Plausible, if a bit complex. What's idea number 2?
This one plays on the China personal health dynamic. Remember, sales might rebound statistically in the second half just because the comparison numbers are easier.
Not necessarily a real consumer recovery, just math.
Exactly. And Philips' personal health is doing well elsewhere. So consider a paired trade. Long Philips stock itself, paired with a short position in a consumer discretionary company that really needs a strong, sustained Chinese consumer comeback to thrive.
So you're betting on Philips' statistical rebound in China plus its international strength while betting against a broad fundamental China consumer recovery.
Precisely. Again, just an idea based on the nuances we heard. not advice.
Absolutely not advice. Okay, let's wrap up this deep dive. What are the main takeaways?
Well, Philips showed resilience in Q1, didn't they? Navigating some serious headwinds like China weakness and tariffs through innovation and trying to execute well.
Yeah, key things for me were the strong orders outside China, those signs of improving margins despite pressures, and the constant drumbeat of productivity and AI-driven growth.
Agreed. The China challenges are definitely still there, but growth in other places and their pretty active tariff mitigation efforts paint a complex picture. It's not all doom and gloom.
So, a final thought to leave our listeners with.
How about this? Philips is really pushing hard on regionalizing their supply chain, speeding up manufacturing investment in the US specifically because of tariffs. Is this just Philips reacting, or is this a sign of something bigger? A preview of how multinational healthcare companies, maybe even others, will have to fundamentally rethink their global manufacturing footprints in the years ahead. Something to watch, maybe?